Blue Owl stock continues to crash, but now there's a major problem. It's starting to pull the entire market down with it. Let's take a look, because today Blue Owl was down 3.35%. At one point it was down 5%. But the big issue here, over the last 3 days, it's down 16%. And if we zoom out and look at how it was over the peak from back in January 2025, stock is down more than 60%. And this is a major concern, because up until now, what was going on with Blue Owl was largely contained to the private credit space. But something changed today in a big way. We started to see some contagion effects leak out. We're seeing it impact the banking sector. We're seeing it impact tech companies. And it even went out further than that. You could see it in the dollar, in gold, and even in the long bond. Because what's really going on here in private credit has me really concerned, because there's a lot of red flags that are starting to show up. Now, if you think back, we've had recessions, we have market corrections, and we typically get through those. But financial crises, they're an entirely different breed. So if you think back to 2007, what happened? We started to see issues in the credit space. But what happened at the time is a lot of people looked past it. They said, look, the economy's booming, the labor market's strong, and the stock market, it's up. And then next thing you know, those issues, they started to get a little bit bigger, and then the entire house of cards came tumbling down. And that's the risk we're seeing today, because now that it's spreading outside of private credit, this is a huge concern. Because when you understand private credit, and this is really the wheels, they really grease the wheels of a lot of small and mid-sized businesses. They're massive lenders. So you think, they do payroll lending. They lend against receivables, payables, inventory, you name it. And if private credit starts to drop and go away, that means a lot of businesses aren't going to be able to access the credit they need. That means they're not going to be able to do the business they need to do. They might default on their loans. They might have to be forced to lay people off. And this is the problem we're seeing right now with Blue Owl, because right now investors want out. And what they're trying to be very clear about is saying, look, you're saying all your loans underneath here are good, but we don't think they are. And now all of a sudden, rather than just focus on private credit, the market today shifted and said, wait a minute, what about the loans at the banks? If private credit's not good, maybe their loans aren't good. And then it started to impact tech companies. Because if you think about from their perspective, well, they need a ton of money for the AI build out. And if credit dries up, well, they're not going to have it. And next thing you know, investors, they're starting to look the other way. So let's dive deeper into here what's going on with Blue Owl. And I want to take you through what's going on in the markets and see how this spread across a lot of other asset classes, because it's a major issue. So first off, let's take a look. Let's go back a few days here, because Blue Owl on Thursday permanently shut the gates on one of its funds. And instead, what they did was they said, look, we're going to sell some assets to raise capital here so we can handle these redemptions. So what they did is they took some of their best loans, they sold them to public pension funds and to large insurance companies. Now, how do I know they sold the best stuff? Because those funds, they're regulated. Insurance companies can't buy junk. They can't buy garbage. Neither can public pension funds. Now, can they buy stuff that turns into garbage? Of course, but they have to buy highly rated stuff. So first off, we see that even Blue Owl knows there's some serious issues here, because they shut the door on the fund. Because if they don't shut the door, what happens? We're going to see an increasing amount of redemptions. And then we have a bigger problem. It's called price discovery. And Blue Owl doesn't want that. In fact, the entire market doesn't want it. Because right now they think this stuff isn't worth nearly as much, but it could be worth a whole lot less. And what we saw is, again, the stock dropped 10% on Thursday on that alone, but buyers kept stepping in. But what happened? The stock can't recover. And then on Friday, well, things changed for Blue Owl once again. And what we see is, for investors in OBDC2, they want it out, but they might have to take a discount. In fact, hedge funder Boaz Weinstein said on Friday he'd buy stakes in the fund and other Blue Owl funds, likely at a 20 to 35% discount. So what he's saying is, look, I don't think this stuff is worth 100 cents on the dollar. I think it's worth a whole lot less. And if that's true today, now can you imagine what happens if the economy continues to slow down? What if the labor market weakens? Well, that means this stuff's going to be worth a whole lot less. And that's what the economy is trying to tell us right now, is it's not getting better. And the market's saying, look, we agree with you and we want to get our money out. Because the problem here is Blue Owl, all they have to do is lock the door. And now we're stuck watching our money get eviscerated. In fact, this even got the attention of Elizabeth Warren. Check this out. I love this quote because it's hilarious to me at one level. She says a shadowy private credit firm is suddenly blocking investors from withdrawing their money. It's not about that, Miss Warren. It's about the fact that if people could get out of these funds, and again, you think back to the financial crisis. Why did the Fed buy up a whole bunch of mortgage bonds? Because if nobody bought them, what would have happened? The crisis would have gotten a whole lot worse, because as funds and banks were forced to liquidate, price discovery would have crashed to nothing, would have taken the entire banking system and the housing market down with it. So if we were to allow Blue Owl, or I shouldn't say we, if Blue Owl was to open the doors and say, you know what, unlimited redemptions, take as much money as you want, what's going to happen to the credit space? It's going to break. What's going to happen to all these small, mid-sized businesses that need loans? They're not going to be able to access it. And then what happens? The bubble bursts. The credit bubble just explodes. And next thing you know, we're headfirst right into a financial crisis. So let's take a look at the knock-on effects here, because I want you to see the tie of this back into the banking sector, because that's what really changed today. That was the first thing I noticed when I pulled up my trade screen. It wasn't that Blue Owl was tumbling down, but check this out. I want you to see why their solvency issue is going to come into play in the near-term future, because Blue Owl, they haven't been around a whole lot. In fact, you go back to 2021 is when they started, but look at what this stock's doing here. Now, I've got this on a weekly chart. So what you're seeing here, this red line, that's the volume profile saying this is where most of the shares of Blue Owl were traded. It broke that last week. Now it's within a couple dollars of a point where that's where people wanted to buy it. If it keeps getting liquidated there, this whole company could go under. But let's take a look at what happened with the bank stocks today, because this was a big red flag for me. And what this was telling me is the market is now looking past Blue Owl, and again, they're starting to put into question, if all of these loans that they've got aren't good, well, maybe the people we need, the consumers, maybe they're in a financial difficulty too. Because you think about it, you go back to the holiday season, what were we told repeatedly? We're going to have a booming second half. That didn't happen. Well, we're going to have a booming holiday season. That didn't happen. So if we didn't have a booming holiday season and all these businesses are stuck with this inventory they can't move, which is putting pressure on private credit companies like Blue Owl, what does it mean for the U.S. consumer here? Well, it doesn't mean good things. And that's what's shifted in the market today. Check this chart out. Let's take a look at XLF. This is large bank stocks, and look what happened. It went plunging down. Now, the days before, didn't have any effect of what was going on with Blue Owl, but today it had a reaction. Now the problem is, let's zoom out here to the 2-year chart. You can see it broke through a level of support. Now what is a level of support? And I gotta zoom in just a little bit so we can get a better picture. That's where previous people have bought XLF. Now all of a sudden, they're seeing their buy price is now higher than current price, which means they're likely to turn into sellers if they're not long-term holders. The risk is there's another level of support just below that. If that doesn't hold, well, what we could see is bank stocks start to follow Blue Owl down. And that's what gets interesting here. Let's take a look. Let's go back to the Blue Owl chart. I want to overlay XLF for you so you can see the relationship between the two. So we're going to add a study here. And we're just going to click that. We'll type in XLF. And XLF is going to show up in purple here. So let's zoom out. And I want you to see just the risk we're facing here. And notice how tightly they are running together, which would make sense. Not much difference between a bank and a private credit firm. They're lending money. This is perfect. And then look what happens. That relationship starts to break down, and you see private credit come crashing down, suggesting that we could see a big drop in bank stocks. Now, I'm not saying that banks are going to go to zero. I'm not suggesting that they're going to plummet 60% off their peak. Now, it could happen in a crisis, but the issue is of where banks go, the broad market follows. And this is how we get into what's happening with tech today, because all of a sudden we saw a little gap down on tech today. Not a big deal. It just dropped off this peak from Friday. But what happened after that? It continued to sell down. And that is a huge red flag. Let's go back now to that chart, and we'll move up to QQQ. And I want to take a look at what's going on here. So let's zoom into today, and what do we see? It jumped at the open, buyer stepped in, and the next thing you know, it just got pummeled. And all effects of what's going on with what's going on with XLF, not QQQ, and what's going on with Blue Owl here. And again, you can see the long-standing relationship between XLF, this is in purple, and QQQ. And so what's happening in bank stocks right now, it's a major red flag. It's telling us, look, something dangerous is coming here. And we've talked about what's going on in tech. You have retail investors all in. You have hedge funds, leveraged loan. You have insiders that are looking to sell, and you have this issue with the 100-day moving average. It's been a problem because it follows 100-day up and it's breaking that now. And this is called a distribution pattern. Now, we've been talking about this on the show for a while, but let's pull up that chart because I want you to see what's going on. And then we're going to zoom back into that because this is, again, it's spreading across all these spaces, and it makes perfect sense because if these tech companies can't get the money they need, and they need it because what did we hear from companies like Oracle? Well, they had negative free cash flow last year. They're going to have more negative cash flow this year. They're going to have to borrow money. They're going to have to borrow money. But if the system seizes up, if credit dries up, they can't get it. And then what happens? You've got a bunch of partially built data centers. You've got a bunch of promised contracts to buy chips, and it doesn't come to fruition. This is a major issue here. So let's talk about this Wyckoff distribution pattern and why it looks so much like what we're seeing in big tech right now. So when you get into a distribution pattern, you see price will rally up and it'll run into resistance somewhere. When price will sell down, it'll kind of oscillate. It'll try to break out. It'll fail. It'll try to break out again and it will fail. And then it'll get down to that last line of support. And then next thing you know, it starts to fall off. And the biggest indication that we're going to see a fall off here is if volume starts to surge. And usually that's an indication that there's now more sellers than buyers. And this is possible because, again, all the data right now says we're running out of buyers. So let's go back to this chart here where we have XLF overlaid so you can see the relationship. So XLF is now saying, look, there's a big warning that tech could come down here in a major way. So we're going to remove that line and we're going to zoom back in because I want you to see just how close it looks to that Wyckoff distribution pattern. So you see it rallies up, gets rejected, pulls back into support. It tries to break out, it doesn't, tries and tries again, tries to make it an all-time high, and gets rejected, pulls down into support. Buyers eagerly jump in, and guess what? Now we've got a failure at the 100-day moving average. So here's what's key. It broke down below the 100-day right here. It's that blue line. You barely see it going across your screen, and then came up and got rejected there, pulled back down. Now I've said it could retest that again. The risk is if it breaks below this lower purple line, that's the support level, you start to see the unwind. But the unwind started today because look at that move down. There was no reason for it other than we're seeing, again, that spillover from private credit into the banking sector, into tech companies. And it doesn't stop there. This whole thing is really starting to get out of control and in a big way. Now, before we go on, I want to show you something really cool because we've been talking about trading. We've been talking about making money in the markets. Now, my subscribers, they just made a quick return on utilities, XLU. Now, how did we know that? Well, we're big swing traders with our system here, and it had an expected win rate of 67%. Now, let's take a look at a chart of XLU because I want you to see just how easy it is for you to make money trading with my system because there's something really cool about it. It's a profit factor of 1.87. And what that simply means is if every dollar that you lose from trading, and if you trade, you're going to lose money. It means over the long term, you're going to make back $1.87. So think about this. You go to Vegas, right? You already know the house is going to win over time. With this system, you win over time. So let's take a look at how we did that trade. We saw it swing up. The system flag that needed to buy gave us a 67% win rate potential. We rallied that up. We moved our stop losses up. We got stopped out right here on this red candlestick because we give our subscribers updates on their risk control levels. We make it so easy for you to, you don't have to sit in front of your screen. Just update your stops every day as we tell you and let the system do the rest. Now, to get in on this, I'm going to give you a 30-day free trial. You guys grab those links in the description below. Be sure to use that coupon code because over time, you're going to make a ton of money with the system, and that's what I want for you. Now, let's go on because we saw this starting to affect some other asset classes today. Let's talk about the dollar because if you're bullish on the metals, I want you to see what's going on here because what's happening in credit is, again, another indication the dollar is going to weaken. And then I'm going to show you what's going on with the long bond. So over the weekend, what did we find out? The Supreme Court's ruling last week struck down many of the tariffs that Trump put in place as the U.S. president has shown no signs of backing down from his signature economic policy. The administration says it plans to replace prior tariffs with a new global levy of 15%, and that sent the dollar down. And here's what some of the experts say. Let's turn to JP Morgan here, because he says we see a new path where the dollar is lower. And we think that last year was just the start of a multi-year trend. Well, the charts, they say that as well. And that's one of the key things here. Let's take a look at what's going on with the dollar, because it's starting to weaken. And that is not good for tech stocks right now, because as we see tech go down, we're going to see a lot of other things come unglued. So here's UUP. This is a dollar bullish ETF. Now, there's a couple things I'm looking at here. We're going to zoom this out in a moment. But the big issue is, see this red line that's going down your screen? This is a 21-day moving average. Now, you can see the price broke through that and then dropped and then rallied up. It got through it a little bit and then got rejected and rallied up and got rejected and then rallied up and got through it. Now, here's one of the key things I want you to understand when you look at trading around moving averages. If it breaks to the downside and then it gets rejected at the underneath it, that's a bearish signal. Now, what happened, though, over the last couple of days, you'll notice it rallied up to the green line. That's the 50-day moving average, which is a little more key here, and it got rejected. So let's look out and let's zoom back on the dollar here and see what's likely to come, because you'll notice that it's sitting in this area of prior support. So you see buyers were here, all right underneath here. What's happened? It broke down, but buyers jumped back and said, no, we do want dollars, we do want dollars. But everything is telling us the trend is going lower. If it breaks this, you look at the volume here on the side, it tells us the dollar's going to drop quite a bit. But the last time it got rejected here, the dollar dropped down to 24. This is a UUP ETF. So if you're bullish on the precious metals here, well, this is a huge indicator, because what it's telling us is the dollar is likely to weaken. And that seems to be exactly what the administration is still keyed on. It will be also important to monitor any developments in the Trump administration's stance on the dollar. This from Derek Halpenny. He's the head of global markets at MUFG Bank. President office suggests he wants the dollar to weaken against other major currencies, seeing it as a way to boost demand for U.S. goods. But that only works if the global economy is strong. And right now, it's not. So what we're seeing here is a setup where not only is private credit looking like it's going to blow up, but we're seeing it pull down on bank stocks and on tech stocks and the dollar. So the setup now is really an indication that we're heading into a financial crisis. It's very similar to exactly what happened back in 2007. Now, let's talk about what's going on in gold here, because if you're bullish on the metals, I've got some charts. We need to take a look at this, because there are enough structural factors in favor of gold in the medium term. This from Vasu Menon. He's a strategist at Overseas China Banking Corp. He said, in the short term, however, expect gold prices to be volatile after the sharp gains in recent months, given the still unfolding developments with U.S. trade policies and the situation in Iran. So the question is it really about geopolitical issues? Is it about tariffs? Is it about the trade war? Or is it more about the dollar? And I think it has a lot to do with the dollar. Let's look at what one other expert said, and then we'll take a look at the charts here. Because gold strength amid lower positioning from hedge funds shows that there's further upside potential. The Commodity Futures Trading Commission data shows that the net long position for gold futures have fallen to the lowest level in nearly a year. So if you're bullish on the metals here, you've got two catalysts. One, you've got to set up for a weaker dollar here as things continue to seeing the economy get worse. As credit weakens, people say, look, I don't want any of these U.S. assets. I want to hold other assets. But hedge funds, they pull back on their long position. So let's take a look at the chart here, because this is actually getting pretty constructive for gold. So let's find out where it is. There it is up here on my screen. And let's zoom into the 6-month chart. And this is what's bullish, because we talk about moving averages, and you can see that 21-day in red. In orange, that's the 9-day, and it's kind of ridden those up. Now, when it broke the 9-day, I was a little concerned here, but it held the 21-day, and it kind of fought there, and then it broke down, and then, well, it held up, and then it shot up. So it tells me, when I'm looking at this chart, based on hedge fund positioning, what's going on in private credit, it's telling me this is a bullish catalyst for gold. Now for silver, and I need to see something change here, and it did by close. I was a little concerned about this, because remember, it broke down. That 21-day moving average right here, that was my red flag. Came down, held the 50-day sort of, held it again sort of, and then climbed back up there on Friday. But most of today, silver could not get through that 21-day moving average. It did. In fact, my subscribers, they're in silver. So you can tell you, we think this trade's got some more room to run here. But what about the bond market? Because again, we're starting in private credit. I want you to see just how it's going across the economy. People are looking at safety, gold and silver. They're going to look to the bond market, and they want out of other things like risk assets, and for good reason. So let's take a look at what's going on here in treasuries today, because treasuries fell last week for the first time in a month as a slate of negative drivers piled up. The U.S. High Court's move to strike down Trump's signature global tariffs threatened to remove, or at least for now, a major source of government revenue used to finance the budget deficit. Meanwhile, jobs data and higher than expected inflation readings suggest that the bar is high for further rate cuts in the coming months. So the market, you look at the media here, they're giving you every reason to say, look, interest rates are going to go up, the long bond's going to go down, this thing's a horrible trade. In fact, some Fed officials even floated the idea of tightening policy if inflation remains stubbornly elevated, according to the January minutes of the FOMC. And so everything, again, is pointing to the fact that yields have to go up. Even Bloomberg put a chart out today. Check this out. It said 10-year yields bounce off key 4% level. And then they overlaid the relative strength index, and they said, look, every time the relative strength index is at a low, what happens? Yields go up. Well, not every time. In fact, sometimes it goes up, but not every time. Now they're saying, look, rates can only go up. And the case is there until you look at some of the other charts here. Because there's another interesting relationship that everyone seems to be overlooking right now. And that's the relationship between rates and the dollar. Let's take a look at this chart. This is from the Fred database. So you've seen me use these before. You can go to the St. Louis Federal Reserve website and you can access this and you can make the charts. There's no cost to do it. But look at this. We've got the nominal broad US dollar index in blue against market yield, treasuries, 10-year treasury yields in red. And going back to early 2022, what do you see? A very tight relationship. Now, it's not perfect, but it falls largely together. So if the dollar's going down here, what is it telling us the path for rates is? Well, it tells us the path for rates is likely lower here. Now, this is interesting because when we look at a chart of TLT, and then I'm going to show you what's going on in the plumbing of the market, because it's all going to tie this together of why what's going on in private credit is likely to see the broad markets go down. And I want you to be positioned correctly for this. So let's take a look at TLT here. And what do we see? Something very interesting happened. There's this red bar. This is called the 6-month volume profile because we're on the 6-month chart. And what does that mean? It's where the most shares have been traded over the last 6 months. And guess what? It's holding support there. Meaning all the people that have been buying at that level, well, they still want to hold. Let's go out to the 1-year chart. And what do we see? Over the last 1 year, buyers have stepped in and continued to buy. Let's go out to the 2-year chart. What do you see? There's a volume profile line. So when you start looking at the data here, it tells us that there's a bullish case for the dollar. And why would that make sense here? Because what are interest rates a function of? Growth and inflation expectations. So what is happening in private credit? It's telling us if we see private credit prices continue to contract, money continue to outflow, they can't grease the wheels of small and mid-sized businesses. That means growth comes down. And if consumers, they're struggling, as we've seen, it means inflation comes down. That means yields come down as well. So what we're seeing here is a flight to safety because of what's going on in private credit, because there are some people that look back to 2007 and said, look, maybe this happens again. In fact, we're even seeing it in the vol space. Let's take a look at what's going on from Goldman. They said investors brace for crash as desk activity is indicative of VIX at 35. Now, if you don't know what the VIX is, it's a volatility index. It kind of tells you how much things are moving. Now, usually when the VIX goes up, it means price comes down. And it doesn't always have to be that way, but for the most part, that's the way it is. So what Goldman's trying to tell you right now is say, look, we're seeing activity on our desk as if volatility was a lot higher. And we're going to look at the VIX too, because it's indicating that what's going on with private credit is likely to have a major impact on the markets. Garrett notes that while boring doesn't begin to describe the index over the last 2 months, and all he's saying here is, look, stocks really have gone nowhere for a while, and it's not very exciting from a trading perspective, but he said underneath, things are a little different. He says, for those in the trenches, over the last couple of weeks, it's been anything but. He said, realized vol spread of the average single stock versus the index just broke to the highest level on record, with the average stock realizing 25 vol points over. So what is he saying here is while you look at the major indices and you see, okay, nothing's really moving a whole lot, underneath you see some stocks are shooting up while other stocks are shooting down. So they're averaging each other out. And what he's saying is, look, this just hit an all-time high. And this is not a good sign, because when we start to take a look at what's going on in the VIX, the actual VIX index, it tells us things are going the wrong direction. So let's zoom in here to the 6-month window. Now, you notice we don't get any volume profile because, well, you can't trade the VIX directly. But look at the trend here. It's going up. It's following its 21-day moving average up. It's following its 9-day moving average up. And every time you see the VIX shoot up, fall sellers, they step in and push it back down, but they can't get it to go back down. That's the problem. They can do it temporarily, but it keeps pushing higher. And what Goldman is saying is, look, right now, the VIX is running as if it was way up here. The last time we had that happen, well, that was back in early 2025. That was when the market dropped by 35%. So what I want you to see here is what's happening in private credit is no longer isolated in private credit. It's starting to spill across a lot of different asset classes. You're seeing it now in banks for good reason. People are questioning, are the loans that banks have any good? You're seeing it spread into tech stocks because they're burning their cash flow. The executives are dumping their stocks. And on top of that, there's a big question is, are they going to be able to get the financing they need when they need it? And then you see it spilling over into gold and silver. Why? Flight to safety. You see the bond market, same thing, flight to safety. How about the dollar? People are saying, look, I don't know what's going on in the US, but it's not good. I want out. And that's what you're starting to see in the VIX here. So as you look at this as a trade, so you kind of walk through this, what do you see? So a lot of opportunities. You know, if you're a short seller, and again, this is only for those of you with the risk tolerance, the stomach, you know, the experience. You know, if you don't have that, don't short, but you could look at being short the major tech indices. You could look at short the bank sector. You could even go after the private credit space. Now, on the long side, look to gold and silver. You know, my trading system already flagged silver. I imagine it's going to flag gold here pretty quick. How about, of course, the long bond? You see opportunities there. The dollar, again, there's another short side. Or if you just have excess dollars, time to get rid of them, trying to invest that money somewhere because your purchasing power is going to continue to weaken. So you see a lot of things are going on here all of a sudden, but today, things changed in a big way when what happened in private credit started to spill out in the broad economy. I wanted you to see that. And again, I appreciate you being a fan. Thanks for watching. Thanks for joining the live. We'll see you tomorrow. And with that, I'm Steve Van Meter. Bye now.